It's the silence that gets me. You spend 3 weeks watching a market bleed out, just a slow, grinding, agonizing drip from $121 down to the mid-70s, and everyone has an opinion. Everyone is a genius when the knife is falling. They tell you it's over, they tell you the industrial demand is gone, that the Fed pivot was a lie, that the tech rotation is sucking the air out of the room. You see the headlines, silver crashes, the bubble pops, and for 19 days, they look right. The chart looks broken. And then today happens. I was looking at the tape around 9:30 this morning, and it wasn't moving like a market that was trying to find a bottom. Bottoms are messy. They chop, they grind. This wasn't that. This was vertical. You blink and spot silver's up 2%. You go get coffee, you come back, it's up 4%. By the close, we are staring at a 6.6% move in a single session. 6% in an asset class that is supposed to be heavy. That shouldn't happen. I don't care what the catalyst is. We'll get to the weak retail numbers. We'll get to the geopolitical noise with Iran later. But normal, healthy markets do not move 6% in a straight line unless something is fundamentally broken in the plumbing. And that's what I want to talk about, not the price. I don't care that we're back at $85.68. The number is irrelevant. It's the mechanics of how we got here that should scare you. Because when you look at the volume profile on this move, it's not buyers stepping in because they love the metal. It's not some sudden realization that solar panels need more conductivity. This is a crime scene. What we saw today was a liquidation event, not of the bulls. God knows they were wiped out weeks ago when we lost 90. But the shorts, the late money, the people who looked at a chart falling for 3 weeks and thought, this is easy money, I'll just short it here at 78 and ride it to 60. They just got carried out. I've been doing this long enough to know the difference between a rally and a squeeze. A rally has stairs. It pauses. It breathes. A squeeze is a panic. It's a rush for the exit where the door is too small and the building is on fire. Today was a panic. And the terrifying part, the part that actually keeps me up at night, is that this might not be the return to normal everyone is cheering for. If you look closely at the order flow right around that $83 mark, something weird happened. The liquidity vanished. The offers just disappeared. That tells me there is a gap in the market structure, a pocket of thin air that we just sliced through. And if we're moving through thin air, it means there is no floor, but there is also no ceiling. We're back at 85. We're right back at the scene of the crime where the breakdown started, and everyone is celebrating. But I'm looking at this chart, and I'm looking at the leverage that just got piled back on, and I'm thinking, this doesn't look like stability. This looks like a trap. The question is who it's set for this time, because if you think the volatility is over just because the arrow is green, you are missing the most dangerous signal on the board. Let me show you what I mean. The problem with looking at a 6% move in isolation is that it feels like an ending. People see the green candle, they see $85 back on the screen, and they breathe a sigh of relief. They think the correction is over and the bull market has resumed. But if you step back, if you actually look at who's exposed here, the story gets a lot darker. Right now, there's a massive disconnect between what the retail investor thinks is happening and what the institutional desks are actually doing. While the headlines are screaming about silver breakout, the underlying data shows that the commercial hedgers, the guys who actually move the physical metal, are sitting on some of the largest short positions we've seen since that blow-off top back on January 29th. Think about that for a second. On January 29th, silver was trading at $121. It felt like it was going to the moon. Then it dropped nearly 40% in less than 3 weeks. Today's bounce to $85, it doesn't even recover half of that loss. Yet the narrative has shifted instantly. Everyone's talking about dip buying and short squeezes. But if you look at the commitment of traders, the smart money isn't buying this move. They're using this liquidity to exit. This is where the first real contradiction shows up. The popular narrative is that silver is rising because the economy is weak, the safe haven play. We saw the retail sales numbers this morning. They were dismal. The U.S. consumer is finally tapping out. Normally, that's good for metals. But here's the thing. Silver isn't just a safe haven. Over 50% of its demand is industrial. If the consumer is dead, the industrial demand for silver in electronics, solar, and automotive should be dying too. So why did it just jump 6% on bad economic news?
It doesn't make sense if you're looking at it through a traditional lens. If the economy is slowing down, silver should be behaving like copper. It should be heavy. Instead, it's behaving like a tech stock on leverage. This tells me that this move isn't about value. It's about a massive miscalculation in the futures market. There's a specific number I was watching today, the $83 level. It wasn't just a psychological barrier. That was the weighted average price of the short positions opened during the first week of February. When we crossed 83 this morning, those positions went underwater, all of them, at once. When you see a 6% move like this, you're not seeing conviction. You're seeing the mechanics of a margin call. You're seeing a computer at a clearinghouse somewhere automatically buying back millions of ounces of silver because some fund's risk parameters were breached. It's forced buying. It's artificial. And that's what worries me, because forced buying eventually stops. Most people get trapped here because they see the price moving and they feel like they're missing the boat. They see the V-shaped recovery and they think it's a safe entry, but they're not looking at the volume profile. Today's volume was high, sure, but it was concentrated in a 3-hour window. That's not an accumulation phase. That's a liquidity grab. I was talking to a friend who runs a desk in London earlier today, and he said something that stuck with me. He said the physical market is actually quite quiet. The premiums on physical coins and bars haven't moved much. This entire explosion is happening in the paper market, the derivatives. When the paper market moves 6% and the physical market just shrugs, that's a red flag. It means the tail is wagging the dog. It means we're in a period of high velocity speculation where the actual underlying asset almost doesn't matter. It's just a ticker symbol for a giant game of chicken between high-frequency algorithms and trapped hedge funds. In a minute, you're going to see why this $85 level is actually the most dangerous place the market could be. People think it's support. I think it's a ceiling that's being reinforced while we speak. We have to look at the leverage. The margin requirements for silver were actually raised by the exchange just 2 days ago. Usually, when you raise margins, the price goes down because people have to sell to cover the extra collateral. But the price went up. That is a massive anomaly. It means the people buying here are so well capitalized or so desperate that they don't care about the cost of holding the position. Who has that kind of capital right now? It's not the retail guy. The retail guy is struggling to pay his mortgage in a high interest rate environment. This is institutional. This is big money moving pieces on a board that we can only see half of. There's a clear contradiction here that most people are ignoring: the US dollar index. Usually when silver explodes, the dollar is tanking, but today the DXY was relatively flat. It didn't move much at all. A 6% silver move against a flat dollar it's unheard of. It suggests that this isn't a dollar story, it's a silver story, or more accurately, a silver shortage of liquidity story. I remember back in 2021, during that whole silver squeeze attempt, everyone thought they could break the COMEX. They thought they could force a delivery failure. It didn't work then because the big banks had more staying power than the crowd. Now, in 2026, the roles are reversed. The crowd is gone. The retail interest in silver has been dormant for months. This is a fight between the giants. If you're sitting there thinking this is a simple buy-the-dip opportunity, you're stepping onto a battlefield where the weapons are billion-dollar swap lines and algorithmic execution. This is where it stops making sense for the average observer. Why would silver be reclaimed as a safe haven now when gold is only up 0.5% today? Gold is the traditional flight to safety asset. If there was a real war panic or a Fed panic, gold would be leading the charge. But it's not. Silver is outperforming gold by a factor of 12 today. That tells you this isn't a macro move. It's a structural move. And that's the part that most people miss. They try to find a reason in the news. They look for a headline about Iran or a headline about the Fed. And sure, those things provide the spark, but the fuel is the positioning. I'm watching the 86.30 level very closely. That's where we are hovering right now. If we can't close above 87 by the end of the week, this entire move today will likely be revealed as one giant bull trap, a way to lure in the remaining retail capital before the next leg down to 75. This is where most people get trapped.
They see the momentum, they feel the FOMO, and they buy the top of the squeeze. They provide the liquidity for the big players to exit their long positions. I'm not saying silver can't go higher. It could go to 100 tomorrow. In a liquidity vacuum, price can go anywhere. But there's a difference between a price move and a trend. Today was a price move. We don't have a trend yet. What we have is a market that is fundamentally broken, reacting violently to a lack of liquidity. And if you're trying to trade a broken market using a traditional playbook, you're going to get hurt. In a minute, I'll explain why the short squeeze narrative might actually be a cover for something much more structural happening in the banking sector, something that nobody is talking about yet, but it's hidden right there in the overnight lending rates. But before we get there, you have to understand the stakes. If silver fails to hold 85, the floor at 75 isn't going to hold the second time. We'll be looking at a gap down to 60. The stakes aren't just a few percentage points. They are the entire structure of the precious metals market for the rest of 2026. This is where the real tension is. Everyone is looking at the $85 breakout. I'm looking at what happens if it fails. What's actually moving the needle right now isn't a sudden love for silver coins. It's a mechanism called the collateral squeeze, and almost nobody is talking about it. You have to understand how these big institutional trades work. Silver isn't just a metal to a bullion bank. It's a high-quality collateral asset. When volatility spikes in the bond market, which it has, and when those retail sales numbers suggest the economy is hitting a wall, the banks start looking for hard collateral to balance their books. They're not buying silver because they think it's going to 200. They're buying it because they need the balance sheet offset.
This is the behavioral signal most people are ignoring. They're looking at the price action and calling it bullish momentum. But if you look at the overnight lending rates, you see a different story. There is a desperate scramble for liquidity. Today's 6% move happened exactly as the repo market started tightening. That isn't a coincidence. Silver is being used as a release valve for a much larger pressure buildup in the financial plumbing. It's easy to get distracted by the short squeeze headlines. It's a sexy story. It's David versus Goliath. But what actually moves outcomes in a market this size isn't the Wall Street bets crowd. It's the flow of institutional incentives. If a major bank needs to de-risk their portfolio, they don't care about the breakout at $86. They care about survival. They will buy whatever price they have to close a dangerous gap in their hedge. That is why you see these vertical moves that don't seem to have a fundamental anchor. It's not a rally, it's an emergency. Now, I have to be honest with you. This is the part where I tell you what would invalidate this entire thesis. Because if I'm wrong, I want to know exactly why I'm wrong as soon as it happens. If silver holds this 86.68 level for 3 consecutive closes and we see gold start to catch up, I mean a real move, 2-3% in gold to confirm the trend, then my liquidity trap theory is likely incorrect. If that happens, it means we aren't seeing a desperate scramble for collateral. We're seeing a genuine, broad-based flight from the US dollar. In that scenario, the $121 highs aren't just a target, they're a floor. I'm not seeing that yet. Gold is lagging, the dollar is stubborn.
So we are left with a binary setup. This is a fork in the road, and the market is going to choose a direction very quickly. Path 1 is the liquidity trap. The shorts have been flushed, the collateral has been secured, and the buying pressure evaporates by Friday. If that happens, the move to $85 was just a very expensive way for the big players to reset their positions before the next leg down. In this path, we likely see a slow, painful drift back towards $78. Path 2 is the new regime. This is where today's move was just the opening salvo. If the $85 level acts as a launch pad and we see industrial users, the solar manufacturers and electronics firms, panic buy because they're afraid of being priced out, then the shorts won't just be squeezed, they'll be incinerated. What most people miss is that the industrial users have been short this market by not buying their 2026 supplies. They were waiting for lower prices. They saw $75 and thought, I'll wait for $65. Today they realize they might have missed the bottom. If they start chasing this price, you're not just looking at a 6% move, you're looking at a structural revaluation.
So, you have to decide what you're watching. Are you watching the price on the screen, or are you watching the behavior of the people who actually need the metal? Because right now, the screen is telling you one thing, but the incentives are telling you something much more complicated. The $85 breakout is here, yes, but it's not a victory lap. It's an ultimatum. Everything we've discussed, the short squeeze, the collateral scramble, the industrial panic, it all leads to a single uncomfortable truth. The market is currently untethered from reality. We aren't in a phase where fair value matters. We're in a phase of consequences. If we look at the scenario tree for the next 14 days, the paths are stark. If the Fed comes out tomorrow or Friday and maintains their higher for longer stance despite the weak retail data, this $85 breakout will likely collapse under its own weight. High interest rates are the natural enemy of silver. They increase the carrying cost for everyone holding the metal. In that scenario, the 6.6% surge we saw today is a dead cat bounce on a massive scale. You'll see the price retreat, likely finding a temporary home around $80 before the market tests the $75 floor again. However, if the data is so bad that the market starts pricing in an emergency cut or even just a significant softening of the tone, then $85 is the cheapest silver you will see for the rest of the year. In this scenario, we aren't just looking at $100, we're looking at a scenario where silver begins to decouple from gold entirely as a high-velocity industrial and monetary hybrid. Here's the playbook I'm working with. I'm watching the 88.50 level with extreme focus. To me, that's the point of no return. If the market can push through 88.50 on high volume without a corresponding spike in gold, it confirms that the shorts are being systematically liquidated and the buyers have total control of the tape. On the other hand, I'm explicitly not chasing this move. Buying a 6% vertical candle is historically one of the fastest ways to lose capital. I've seen too many people get excited at the top of a squeeze only to be the exit liquidity for the very funds that triggered the move. I'm waiting for the retest. If $85 holds as support on a pullback and the volume stays thin on that pullback, then I'll believe the breakout is structural. My stance only changes if we break $94. That's the level where the technical damage from the January crash is officially repaired. Until then, this is just high-stakes noise in a very expensive sandbox. I'm looking at this and I'm seeing a market that is trying to tell us something about the health of the financial system, not just the price of a commodity. When the plumbing starts leaking this badly, you don't worry about the decor, you worry about the foundation. I'll be watching the silver to gold ratio tonight. It's currently compressing at a rate that suggests a major shift in capital flows. If that ratio continues to tighten while the dollar remains flat, we are entering a new regime of volatility. One thing is certain, the slow grind is over. We are back in the era of the violent move. Does this feel like a genuine recovery to you? Or are we just watching the final desperate exit of the people who got the direction wrong? I'm genuinely curious because from where I'm sitting, the technicals and the fundamentals are currently shouting at each other. Next time, I want to dig into the internal memos coming out of the major industrial silver consumers. There's a shift in their hedging behavior that suggests they aren't just worried about the price, they're worried about physical availability. We'll look at those documents then. For now, keep your eyes on the $83 floor. If that breaks, today never happened. The question I keep coming back to, and the one I think you should be asking yourself, is whether you believe this move was driven by strength or by a lack of alternatives. It's easy to look at a screen and see a 6% gain and feel like the world is right again. But markets don't usually explode vertically because things are healthy. They explode because someone, somewhere, is being forced to do something they don't want to do. We've seen the retail numbers. We've seen the repo markets tightening. We've seen the disconnect between the paper price and the physical premiums. To me, this looks less like a breakout and more like a warning shot. It's a signal that the liquidity we've all taken for granted for the last few years is starting to evaporate in the places it matters most. I want to know where you stand on this. Do you see $85 as the new floor for a run to triple digits, or do you see it as a temporary peak designed to lure in enough capital to let the big desks flip their positions? There isn't much room for a middle ground here. We are either in a new regime of scarcity, or we're in the middle of one of the most sophisticated bull traps I've seen in a decade. I'm leaning toward the latter until the physical market starts to lead the paper, but I've been wrong before. If gold starts to close the gap tomorrow, the math changes instantly. Next time, I'm going to share a specific document I've been tracking, an internal supply chain assessment from one of the largest solar panel manufacturers in Southeast Asia. Their behavior over the last 48 hours tells a very different story than the one you're hearing on the news, and it involves a specific metric for days of inventory that just hit a 5-year low. If that trend holds, the price of silver might be the least of our concerns. We'll pick it up there. Keep an eye on the $83 level tonight. If we lose that, everything we saw today was just a ghost in the machine.
It's the